Technical analysis is often misunderstood as a mathematical formula to predict the future. In reality, it is a method for reading human psychology. Every chart is a historical record of the ongoing battle between buyers and sellers. This chart shows a chaotic overlay of technical indicators. Beginners often load their screens with moving averages, volume bars, and Bollinger Bands, creating confusion. To understand the market, we must strip away the noise, removing these bands until we are left with only naked price action. This diagram compares the anatomy of candlesticks. The solid body shows the distance between opening and closing prices. The thin lines above and below show the absolute high and low. Green indicates buyers pushed the price up, while red means sellers drove it down. Before you can map the broader market, you have to read these individual psychological footprints left behind by the buyers and sellers. Once you understand single candlesticks, you can start identifying historical trends. Support is a price floor, where demand overwhelmed supply. Resistance is a ceiling, where supply overwhelmed demand. A common mistake is treating these levels as exact, down to the penny price points. For example, assuming support sits exactly at a strict $100 line. Markets are messy. If the price dips to $99.50, panic sets in. Traders holding at $100 will often trigger their stop losses and sell, only to watch the price violently reverse upward as buyers step back in. The solution is to remap these levels. Instead of rigid lines, support and resistance should be drawn as thick, shaded zones. These represent clusters of buy and sell orders. Notice how the price action compresses and bends into the lower zone like a trampoline before bouncing up. Normal market volatility will pierce thin lines. Surviving that noise requires operating within these wider zones of probability. With our zones in place, we need to know exactly when to enter a trade. The long candlestick wicks provide real-time visual evidence of aggressive fighting and price rejection. This chart illustrates a rejection pattern at the bottom of a downtrend. Look at the circled green candlestick. Sellers pushed the price deep into the red, creating a long lower wick, before buyers fought back to close in the green. This is a hammer. Let's test this concept. We have a downward trend approaching a historically tested blue support zone. Based on what we just covered, pause and visualize the exact candlestick shape required to prove buyers have stepped in here. You need a long wick rejection candle, like a hammer or a bullish engulfing, forming entirely within that zone. Its wick pierces the bottom, absorbing the remaining sell orders, but closes strongly near the top. Entering a trade based on this specific wick ensures you are reacting to literal proof of demand, rather than blindly guessing where a falling market will stop. This chart shows what happens when structural zones break. On the left, price repeatedly pushes against a historical resistance ceiling, unable to break through. Finally, strong buying pressure shatters it. When resistance breaks, psychology flips. Traders wait to buy on a dip, turning that old resistance line into a new support floor. We wait for the price to pull back to this newly flipped zone. Seeing a rejection wick form exactly at this level proves the market has accepted the new upward direction. This exact moment is the only time an indicator, like a moving average or volume bar, should be applied to your screen. You use it to confirm the narrative you have already established. Mathematical indicators are merely the echo of the market. Raw price action is the actual voice. To build a reliable trading foundation, stick to these 4 rules. First, keep your charts naked. Clear the mathematical clutter so you can read the market. Second, draw zones, not lines. Treat support and resistance as thick areas of historical supply and demand. Third, wait for the footprint. Look for long rejection wicks at key levels to prove the buyers or sellers have taken control. Fourth, confirm, don't predict. Use indicators sparingly and only to back up what the price action is already telling you. True technical analysis does not provide a crystal ball for the future. It gives you a systematic tool for measuring the exact balance of power in the present.